All right. We are live. Let's get this party started on this happy Monday. Hello, Smart Money Cheap Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with my good friend Doug Hagren. Hey, Doug.
Good morning, Kirk. Happy Monday, right on time, ready to rock.
Right on time, right bright and early. We're both happy and chipper on this Monday morning.
Absolutely.
Yeah. So we'll dive right in. We got a lot to cover today, and markets are changing pretty rapidly. And today is the last day of the quarter, which I'm just going to make a quick. I've got a lot to talk about, so I'm just going to make this quick point. As today is the last day of the quarter, there's always a little bit of what's the old days they used to call it, tomfoolery going on. So what I think you'll find is the end of the quarter, there tends to be a lot of what people call window dressing. And window dressing is people need to make their fund or ETF or whatever kind of money they're doing that where they publicize a return. You know, at the end of the quarter, a lot of funds will have to share what their holdings are. So they'll change stuff around to make it look like, oh, this is the best performing stock. Let me buy it right before the end of the quarter to make sure that everyone sees that I own it. So just silly stuff like that. It doesn't happen as much as it used to in the old days, but it still happens to some degree. And what people need to realize is at the end of the quarter, it does matter. The end of the month, end of the quarter, end of the year. These are times where people make big decisions. So the end of the year, the big decision is tax loss selling. So if you take some bottomed out stock or industry, I think it was like 2020, it was 21, 22, or 23. It was when Bitcoin bottomed out. If you look at it, the lowest point of the year was like the last day of the year. Why? Because everyone's doing tax loss selling. And they figure, well, we'll take the losses now and we'll ride the gains later. So what people did is they sold their positions, waited 30 days, and then bought them back. And what that does is you could typically see this for assets at the end of a year. Now, if you look at the end of the quarter, things move around. But I look at these time periods for big shifts. So sometimes the end of September, which is the end of a quarter, there tend to be that tends to be a good time when things bottom out. So just be mindful. I'm not saying this is, but we've seen a sell-off in the markets, and it could be a time where the markets pivot. It could be a time where things get better, or it could be a time where things start to get a lot worse. But you just need to be mindful, or just be mindful. Nothing could happen. But these are things that you need to be in the back of your mind thinking, all right, have things been ultra bad? Which I don't think they have been. But if they have, it's like, all right, maybe this is a good time to take a bite of the apple here. So just be wary that this does happen in Wall Street. Doesn't happen all the time. You can't run your clock by it, but if there's a pivot, sometimes it does happen, and just be aware of it. Now, we're going to talk about a lot of stuff today. I'm going to share two stocks as a comparison. I think it's actually a really good comparison from a fundamental standpoint. But I also, more importantly, I want to talk about Social Security. Now, I've gotten I can't even count. I've gotten way too many calls from clients, from prospects about Social Security. So I figured, what better way to address Social Security than on the show? Because everyone else is having this challenge too. All right. So let's tell a little bit of backstory about Social Security. So Social Security was basically created back in the Great Depression era as a way to make sure that people didn't starve, right? And it was mainly for people who were really old by those standards, the people who didn't have support. This is really for people who couldn't support themselves and didn't have any money. So it was, it was a safety net for people who couldn't take care of themselves at that time, when they retired. And, which is a good idea, right? I don't think anybody disagrees with that. I think it's a good idea to support people who can't support themselves. Fortunately, there's such a small segment of society that it's not a big deal. However, like much of what the government does, it turned into a boondoggle. So now everybody's impacted by Social Security. It's not just for the infirmed or the very old. Now it's for everybody who reaches a certain age. Now, when they started it, it was supportable because there's a lot of people supporting a very few amount of people. Well, that's supportable. Nowadays, you have everybody who's working supporting everybody who's retired, which might be okay, except for the fact that the baby boomers have, like a pig in a python, have hollowed out pretty much everything that they touch. So they were paying into Social Security their whole life, and now they're taking out. The problem is they have a big segment of society, and then Gen X is smaller, and then the millennials is bigger. So you have this kind of accordion thing with the demographics. The problem is millennials are a big generation, and so and the younger generations aren't paying enough in to support the millennials pulling out. So effectively, Social Security is going to be insolvent by the early to mid 30s. That has been there for a long time. That is nothing new. It is not because of Musk or Trump. I know some people think it is because they watch the news. This is why we tell you don't watch the news. It's just propaganda. It's just people trying to manipulate you. Social Security has been in this deadline, or this wall has been there for a long time. It was there under Bush. It was there under Obama. It was there under Clinton. It's been there for a long time. And there's not, I think Bush tried to do a little something, but it amounted to very little. So there have been some changes over the years. I think it was under Clinton where they started to tax Social Security. I could be wrong, so don't yell at me if I am. But it was around that time where they started to tax Social Security income for certain people if you made over a certain amount. And I think under Bush, they extended it out a little bit. So I forget the years they extended. But basically, here's what you need to know. Social Security is going to be insolvent around the early to mid 30s. That's a fact. The numbers don't lie. So the only way you solve this problem is you do what most politicians have done since this is, became a problem, is you can extend and pretend, or you just don't touch it. It's the third rail of politics. Nobody wants to touch it because all it means is that if you do something that saves it, it means you won't get reelected. That's why politicians don't touch it. So let's be frank, both sides of the aisle, no one wants to touch this. So the only way to deal with it, because it's way too late to fix it, is to do something drastic and innovative. Now, math is math, so it's just too late to fix it. You can't fund it. You have to do something really drastic, and of course, no one likes that. So here's the outcome. If they do nothing, they'll run out of money by the early mid 30s. And what will happen is effectively we will be funding it out of our budget because the government's not going to let it fail. Because you will literally vote out every single politician in office if that happens, and they don't want that. So they don't want it to fail. So they will run it out of the budget. And that is going to be really, really expensive. And we're going to have to start printing money. We're going to have high or hyperinflation. It's going to be a total shit show. Not only that, but we also have Medicare and pensions all running out of money at the same time. It's going to be a complete disaster because our politicians have done nothing to fix it. Now, Trump and Doge are talking about doing that, and I commend them for it. I don't know if they'll succeed. I give them an A for trying because it's an insolvable problem with our current standard of how we're doing things. So if they find a way to solve it, which I have heard some proposals and they are very interesting, I don't know if they'll work, but they might. And so I'm very curious to see what they come out with when it's done. But the proposals have been pretty interesting. Now, here's the problem. Everyone's got a stake in this. People who've paid in for their entire lives, people who work there, people who care about other people, everyone's got a stake in it. So it's not going to be an easy transition, no matter what the solution is. It's not going to be easy. And so what we've been hearing on TV from the left-leaning shows that are trying to brainwash people is that Social Security is going to go bankrupt and Elon Musk is going to steal your Social Security and they're going to ruin it and it's going to be the end of the world and Elon Musk is the devil and Trump is too. And that's what you're hearing, right? Basically. And the reality is that's not what Doge is talking about. What Doge has been talking about is cutting the Social Security administration, not your benefits. Those are two separate things. There's Social Security benefits, which is what you paid into. It's this, it used to be a pile of money. Now it's a pile of IOUs because the government got their hands in it. So Social Security is basically a Ponzi scheme. Just in case you don't know with the numbers, Social Security is a Ponzi scheme. It just so happens as a government Ponzi scheme. So as soon as more people start pulling out, that's when it falls apart. All Ponzi schemes fall apart when more people pull out than put in. You don't have your own account or anything like that. It's just basically this pool of money and everyone puts their hands into it. So, so effectively, what Doge has been talking about is cutting the administrative costs because the administrative costs are quite high. I don't know the numbers off the top of my head, but I had heard somewhere about a third of the money going in goes to administration, which seems pretty high. I think you could probably do most of this with computers. You do need a few people because old people need someone to talk to. And Social Security is this complex beast. I'm just going to be frank. Like, no matter which side of the aisle you're on, Social Security is a complex beast. You need people to administer it. You do. Now, most of these people are incompetent or they don't understand their own system. But you do need people there because the government systems are not they're not perfect. And they break and there are mistakes and you do need people there. But you probably don't need as many people as are in there now. So the question is can you improve it? Can you fix it with technology? Can you fix it with better people? I don't know. That's not my problem. It's what Doge is dealing with. But the questions I've been getting are, should I take my Social Security now before they take my Social Security, which is what people are being told. That's not true. They're not taking your Social Security. So here's what's probably going to happen. Here are the probable outcomes based on history. Now, I don't know what Doge is going to do, but based on history, here's what I expect. So the last time they made changes, what happened was they extended out the dates. So it went from, let's say, I forget that it was like 58 or something like that, 58 to 62. It went from like 65 to 67, something along those lines. I could have the ages a little bit wrong, but basically extended out to 62, 67, and 70. And if you were within 5 years of pulling Social Security, you were not affected. I think it was actually 7 years. I think it was if you were like 55 years old or up, your Social Security was not impacted. You were able to get it at the normal age. If you were under 55, you were impacted. Now, I like this because if you're within 5 to 7 years of retiring, you actually have time to figure your stuff out. You can save more. You can get another job, whatever you need to do to make sure that you can retire on time. That's a responsible change. I don't like the government very much, as you all know, but it's a responsible change. I give them credit for being thoughtful about that change. I don't like the fact that it's a change, but, like, let's be honest, it had to happen. So that I think is reasonable. If they do that again, and I don't know that they will, what I'm hearing is actually they may even increase your benefits, which I'm going to put a pin in. I don't think that's going to happen, but I do think they will make it solvent. I think some of the things I've been hearing will make it solvent, which makes the problem go away. So I don't know what's going to change, but from what I'm hearing, it could happen that doesn't change at all. Now, so what they could do is they could say, all right, if you're over a certain age, you're not impacted. Everyone under a certain age is. That's the most likely scenario. They're not going to take it. It's not going to disappear. None of these politicians want to get unelected, so it will not disappear. If it does, you can call me out on it, but I would say 99.999% chance it's not disappearing. Okay, that's me saying it's not 100%, but it's pretty darn close. So there's that. I do think the government, what they've proposed in the past is extend out the age when you apply, because originally It was for like 1% of 1% of the population. Almost nobody qualified for it. I don't think they'll do that because everyone's kind of expecting it. So there is the age qualifier, which they could mess with. There could be the income qualifier, which means that you get less than you think, or there's no COLA. And for those of you who don't know, COLA is not a drink. It's the cost of living increase. And so there's the COLA, which they could mess with. They could mess with your amount. They could mess with your income. So if you're making $300,000 a year in retirement, they could say, well, you don't really get Social Security because you don't need it. They could do that. They've talked about it over the years. It's been proposed. People find it to be palatable, which I think is, it's reasonable. Like if you're making $500,000 a year, you probably don't need Social Security. However, the number of people who are going to make $500,000 in retirement is such a small number. That's more class warfare than it will actually impact the numbers. So just to be clear, it feels good to beat up on the rich and get all the rich people and attack the rich. It's their fault. The reality is there's so few people who are making that kind of money. You're not really impacting Social Security. All you're doing is making yourself feel good because, they got money and you don't. So the reality is that's nonsense. It sounds good on paper, but it's complete nonsense. So the reality is the age and the amounts may have to change at the current status. Now, if some of the things that are being proposed do change, which is funding it through some of the actions that government's trying to do, sovereign wealth fund, funding it through monetizing government assets, then we could have to not worry for another 50 years till politicians do something stupid once again. But I want you guys to be clear. There's one thing I want you to be clear about. Everything we talked about is interesting, but we have no idea what they're going to do. And this is going to require Congress. Trump's not doing this. Doge isn't doing this. Doge might clean out the excess, but they're not going to take your benefit. They can't. It's not under their purview. Congress has to do this. So that's going to take a while. You're going to have time to think about it. You're going to have time to read through the proposals. They're going to have to vote. People are going to talk about it on TV. You're going to have plenty of time to think about it. Do not rush to make a change today because some clown on TV scared the pants off you into taking it because you thought you're going to lose your Social Security. Don't do that. Make a rational decision based on numbers and based on what you know. Because here's what's going to happen. That's going to take time to happen. You've got plenty of time to make a decision. If you're, if you're within retirement age, if you're 62 years old or older, take your time. Don't make a decision today. Wait until they do something you don't like and then make that decision. Don't make it on speculation of what's going to happen in the future. Because let me tell you something. You're bad at predicting the future. So is Doug. So am I. So is every single person on the planet. Nobody's good at predicting the future. We're very bad at it. So don't try with one of the most important decisions you can make in your life. Wait until you have to make the decision. If you're close, if you're 62, just wait. You can pull any time. They're not going to take your benefits away if you're 62. They can't. It's irresponsible. And no matter what you think about the government, it's not going to happen because too many people would be running around with pitchforks and torches. That's not going to happen. They can't do it. It's not feasible. What they could do is mess with the rest, but not when you're in that final stage. So don't freak out. Make a strong decision, right? Make an informed decision and make a good decision. Don't speculate. So that's my 2 cents in Social Security. I want everybody to know it. I want everybody to think about it. Take some time. Don't make a decision today if you're in that boat. If you have questions, you can call us. We're happy to talk you through. But we're very well informed on Social Security, but just be mindful. Just don't be driven by fear, because fear is what keeps the news stations in business, and it's not necessarily to your best interest. On to you, Doug. You got lots to talk about today. What's in your plate?
So no input on Social Security. We're moving
on.
No,
go ahead. You talk about it. Yeah, whatever you want.
No. So,
Mike.
Here's the thing. They have always made changes to Social Security. They constantly tweaked with it. And anybody that thinks that, what is as is going to be what is, and we're just, you're screwed,
Settle down, Kamala.
What'd you say?
I said, settle down, Kamala. What is,
Right.
and isn't it?
Right. What was it? What's her line again? I'm forgetting.
It'll be what it'll be. I forget what it is.
Yeah, whatever it is right now. So, excuse me. Just a couple years ago, Social Security planning, which is still important, was a huge talking point. And the reality is every time something in Social Security, especially anytime something becomes a huge talking point of something you can do that takes advantage of a government system, guess what? The government tends to hear that and make a change and take it away. So a couple years ago, you could do some really creative things. You could actually take your Social Security as early as 62, and as long as you decided to refund it, because it's about a 30% reduction for life of your Social Security at 62. Now, there's pros and cons to that. You could take it early, but you're getting it for, for the average for the person now that might be getting it at the age of 67 to get full retirement. So if you take it at 62, early retirement, that's 5 years you can collect. And so, yeah, it might be a 30% reduction, but I mean, you're collecting it for 60 months. And if you're prudent about that, and again, if you don't need the money necessarily to live off of today, then, you could actually take that money, capture it back, invest it. And, you'll have less by the time you're 67 per month, but there's a break even period that in general, takes roughly anywhere from like 10 to 15 years. If you were to wait till 67 or full retirement to take your money versus getting it early, 60 months earlier, how much money you would have collected. So one of the things you got to think about is, do I take it early? Do I take it late? Well, it depends. Do you really need the money at 62? Then you might want to take it early. And, if you're going to wait till 67, life expectancy comes into play there, right? Because if you're going to take it at 67 and die at 75, well, probably should have taken it at 62. But if you're going to live longer, there's going to come a point where you're going to have more money because you waited longer. But here's what they allowed you to do a couple years ago. You could take your Social Security and you could collect on it starting at 62. And that's, and what you could do then is, like, at 67, you could refund all of that money. And of course, you'd get to keep the interest on it. Turn around and tell the Social Security Administration, never mind, I'd rather take it at 67. As long as you paid everything back, they would let you then go ahead and start taking the new payments at 67 as if you'd never waited. Well, guess what? There was a lot of moving parts and things were shifting things around. And the government took that away. They took all of these moves. There was more to it than that, but they took them away. And they said, you know what? You can't do that anymore because that's costing us money. That was a simple shift that the government did that had a tremendous impact on the solvency of it. Because people were taking advantage of that system, rightfully so. But now, when you elect, that's your election for choice for life. And the government basically calculates, okay, when you take it, now this is the best optimal amount, not necessarily for your lifestyle, but the amount, and that's what it is. And so they already took that away, which changed significantly the future outlook of solvency. Going back to other changes, they gradually increased that retirement age from 65 to 67. So some of the older generation that are, now in the 80s and 90s, they were collecting Social Security, and I don't remember exact age, but they were collecting it at full retirement at 65. They made it 67. Now, you can wait longer and have it increase further if you wait till 70. But listen, all they have to do is flip a switch, make full retirement 70, and it's going to put billions and billions of dollars back into Social Security and longevity. It's a simple thing. So there is probably going to be more incremental age adjustments. It would not surprise me if they do that to younger generations. And all of a sudden, Social Security is somewhat fixed. You could also have, adjusted cost of living calculations. The government has done this forever. Make some adjustments here, make some adjustments here. What goes into it? If you slow the pace of benefit inflation, they're going to extend solvency. As you talked about, there's a cap, right? So right now, income above $160,000 isn't subject to Social Security payroll tax. There's a lot of talk about raising or removing that. If they do, there is a lot of people. I've got some numbers in here of what the top 1% in the United States now is worth in net worth. This is not based on income. We've looked at those too. But I mean, if you all of a sudden took that cap away, boom, right there, fundamental shift to Social Security. They could also increase the rates. Right now, it's 12.4% split between employer and employee. They raised it 0.5% to 1%. Boom, program possibly stabilized. I mean, there's so many things, Kirk, they can easily do here. And the thing is, it isn't new. They've always done this. They've been making tweaks and adjustments to Social Security forever. And it's kind of like Ethernet cable. It's the way it was described to me years ago. Ethernet versus, the old internet and LAN T1s and all that is basically, like you said, kind of like a Ponzi, right? Is you're going to get some bandwidth on the end no matter what happens, but the more people that tap it, the lower the pressure you're getting, just like a water pipe. Same thing with Social Security. The more people that tap it, the lower the pressure it's going to be. And that's going to, you're never going to run out because it's a pay in, pay out system. There's always going to be money trickling in. But I want to go back and talk about some history because you mentioned a couple of things. It's been very nonpartisan. The first major Social Security amendment of taxation was 1983 under Reagan. It went into effect in 1984. That is when they started to tax 50% of Social Security for anyone earning over $25,000 or $32,000 as a couple. It was Clinton that changed it again 10 years later in the Omnibus Budget Reconciliation Act of 1993. So in 1994, that's when they raised it to a maximum taxation of 85%. People don't necessarily, a lot of people, I talk to people, they don't understand how it's taxed. Basically, some people don't pay any tax on Social Security, although it's, again, if you make basically over, I don't know what it is right now, maybe I think it's still the 25,000, that's when you hit 50% of it is taxed. So you're getting half that free back. And then once you hit 44,000 as a couple, they're taxing 85. That's 15% of your income they're not taxing you on. So guess what? Right there, if they went and taxed 100% of Social Security, and believe me, I'm not an advocate of this, so don't start throwing, virtual knives and darts my way. But these are the things the government could easily do, right? I was looking at the administration costs. We were talking about that. Right now, of all the agencies, I know there's talk about administration, but SSA actually, based on references and information out there, has one of the lower administration costs of all of the programs. It's about 1% of total intake. So 99% of funds are directly supporting benefits. And it's been consistently that since about 1989. About $99 goes out at benefits. The problem is we just don't have we have too many ways in which the amount of money coming out is getting cut through through extensions and through when people take it. And again, as you mentioned, the younger generations, we've got a lot of charts and things we've talked about, and we can go over again today. They're not earning and making in relation to cost what they used to be. So, summarize it, because I know you already spent a lot of time on this. Permanently reduce benefits. That's something they could do. Extensions, legislative process. There's historical precedent to adjust it. And the reality of it is you should not be making any proactive decisions on Social Security without two things. Number one, assess your own financial circumstances and what you're going to need. And number two, understand that any decision you make right now, all it takes is and we know how this works, Kirk, 3 a.m. vote that nobody knew was going to happen, right? And all of a sudden we wake up in the morning, Congress just votes to blah, 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 Social Security. Everybody must wait till 72 to now take full Social Security, and Social Security is solvent for the next 100 years or whatever it is. You can't make those decisions. I do take offense, though, to you saying that I don't know how to predict the future, Kirk. I mean, I'm a little wounded by that, but I guess, we'll have to go forth with that, assumed reality. So.
All right. Well, I'm sure I'll get over it.
But will I?
Yeah, you might not. I don't know. Doug's very fragile. Fragile flower.
Right. I do want to say, by the way, one thing I want to go back to is something you started the show. And you were talking about the markets. And I think I'm getting a lot of questions on that too. I actually have someone who emailed me and said, I should have gone with my gut. I've listened to this podcast. He might be listening to this one. I should have sold up. Now I'm looking at these losses I've got to get. Here's the thing. And we've said this in a couple of these. Number one, this is one of the more volatile times of the year, period. Always has been. We don't know 100% if it's tariffs. I'm sure that news, and those impacts have some impact. We don't know if, it's, other types of concerns coming in there, or is it just seasonal? But you do have a post, a chart, a graphic, Kirk, that you put up there, which I thought was perfectly poignant to what you said. March 2025, since 2012, was the third highest weekly inflow. I don't know which week they're talking about because they didn't actually put the week there. But by the dip reigns, the third largest weekly inflow to equities ever from I call it GWIM clients. But basically, this was a Bank of America investment research. Private client inflows to equities as a percentage of AUM. It's the third highest since 2012. The other two, January 2021, coming out of COVID, and there's a lot of inflows going on then when the markets were down, and September 2022, huge spike after all of the the economic and market woes we had in the interest rate impact of the markets 2022. So we started to see this kind of trickling up. I don't know if it's sustainable, but just for people out there that are absolutely scared that the ground's going to fall out from underneath you, there's a lot of people moving money into the markets right now, which happens a lot when the markets pull back.
Yeah, so I'm going to share this with everybody. So we talked about valuations the last few weeks. I'm going to share a comparison of two stocks. Now, here is the last 2 years of the S&P 500 returns with all of the stocks and then without the Mag 7. With all the stocks, 2023, 24.2%, 23.3% in 2004, with all the stocks. 2023, if you remove the Mag 7, which is basically the 7 big tech stocks, the return's only 4.1%. So 24 down to basically 20% less without the Mag 7. 2024 goes from 23.3 down to 6.3. So that's 17% less. Now, that's without Mag 7. So obviously Mag 7 has contributed an enormous amount to the returns of the S&P 500. So in the standing of that, let's pull out two stocks in the Mag 7 and let's compare them. Now, I used Guru Focus for this, and I don't agree with all the stuff here, but let's just, for the sake of argument, let's assume all of it is 100% right. Now, one of their screens, they look at a lot of these ratios, and they basically compile all this: financial strength, growth strength, momentum, liquidity, Guru Focus value rank, profitability rank. Anyway, so they look at all these different things, and there's tons of them. There's I don't know, there's about 40 of them on this page. Return on equity, return on assets, cash to debt, moving average, quick ratio, pretty much anything you could imagine is on this page. Now, this is one of the Mag 7 stocks. The growth rank is 10 out of 10, financial strength 6 out of 10, profitability 10 out of 10, the value rank 5 out of 10, momentum 9 out of 10. Not sure I agree with that, but that's all right. Anyway, so I'm not going to go through them all, but the PE ratio of this stock is 35 and change. 35. Last week we talked about this. The long-term average PE of the S&P 500 is 17. So this is basically double the historical average of the S&P, okay? And so you look at all this, you look at price to sales is 8, price to book is 50, PEG ratio is 2. All these are ridiculously terrible. So if you look at the growth rank, just visually, let's say you don't know what I'm talking about at all. For those of you who do, you can look at this and you're going to be shocked. But those of you who don't understand it, I'll make it simple. Green is good, yellow is okay, and red is bad. So if you look at these, they have two sets. They have the number, they have the how they're doing versus the industry, and they have the how they're doing versus history. So compared to the industry, some of them are green, which is good. The profitability sense, they are 10 out of 10, and I agree. They're a very profitable company. The growth is yellow, which I think it should be red. They haven't grown in 3 years. It says here the current growth rate, the 3-year revenue growth rate is 5.4%. I think it's actually zero. But anyway, that's neither here nor there. Point is this company's not growing. And it has a PE of 35. And it's not just it didn't grow last year. It hasn't grown for 3 years. That's a bit of a problem. And at some point, this company is going to be a lower price. Because if the revenue doesn't grow, the profitability doesn't grow, which it's not, then eventually this is going to be too expensive of a stock. Now, at a PE of 35, it means the company's growing at a pretty good clip in order to keep up with that PE. Unfortunately, this company's not growing, and they still have a really expensive PE. But if you look at all the metrics that matter, they're basically yellow or red versus the industry and versus their own history. Now, they were a profitable company. They were growing quite a bit, and now they're not. So that's one page. Another page, here's just some more numbers. Dividend yield. I'm not going to give you the name of this company. You could probably figure it out, but I'm not going to give you the name of the company because it's not about that. I'm just showing you a comparison. Here's another one. Here's a valuation chart. Here's their valuation of what it's worth, 193 a share based on Guru Focus's value. The real price is 223. But if you look at like Peter Lynch, or if you Graham's number is 26, which is far off Peter Lynch, 102, discounted cash flow. So you look at all these different metrics for valuing it. It's way overpriced. If you look at this one, this is a chart. It shows more visually for those of you who are visually inclined. It is 10% or more overvalued. And this just shows color-wise, like when's the time to buy, when's the time to sell. Well, it's time to sell according to this. And then here's just a history. And I like this one because it shows a history of some of the metrics. So revenue and EBITDA, as you can see, the last few years have been flat revenue, flat EBITDA. Cash and debt, the debt is kind of stayed right around the same. It's up and it's down. Cash has declined, it's coming up. So it's down a little bit. Most of the metrics, return on invested capital, about flat. Operating cash flow, free cash flow, net income are all flat. Shares outstanding are going down. Share buyback ratio is pretty good. It's close to 3. Stockholder equity, total assets. So most in the last few years have been flat. Now I want to share another Mag 7 stock really quick, just to give you a comparison for how you should be looking at stocks. And I'm not saying you should buy this one, but here's one that is, let's say, doing a little bit better. Let me pull up this. Okay. So here's a different company. As you can see, revenue's increasing, net income is increasing, EBITDA is increasing, the debt and cash are declining. Operating cash flow, free cash flow, net income, all these things are increasing. Shares outstanding are kind of the same, so they're not really buying back that much. Total equity is increasing. These are numbers that are a little bit more in line. Not saying they're perfect, but they're a little bit more in line with what you would expect from a company that has a PE of 31. Now, the value, it's a better value according to this. Profitability is still great. They have great profitability. Financial strength's really strong. Growth still relatively strong. They're 14% annual growth rate, which is not as good as it used to be, but it's still decent. Momentum's, I don't know if I agree with 7 out of 10, but that's okay. But if you look through here, you're going to see very different numbers. This one has a lower PE and it's still growing. The other company had a higher PE and it wasn't growing. Why is that? Well, in large part, the Mag 7 are big companies that everyone owns and everyone has in their portfolio because they get fired if they're portfolio managers and they don't have them. So everyone's got them. Well, the problem is they're not growing. So why would you have a company that's not growing? There are plenty of companies that are growing. But as you saw earlier, if you pull out the best, quote unquote, best stocks, the Mag 7, your performance goes down to the same return as a 3-month treasury yield. Pretty much the same. So you're taking no risk for investing in treasuries, virtually no risk, sorry, versus equities, which you are taking risk. Why would you ever do that? And the Mag 7 aren't really growing right now. I don't know if anyone's paid attention, but they're not really growing right now in stock price. If anything, they're declining in some ways. So you want to be cautious about thinking, well, let's just buy tech all the time. It's just going to the moon. I would be very, very cautious about all the Mag 7 stocks. They're very overvalued. They are, I'm not sure if I can share all of this. Yeah, here's another valuation. And it's below, it's undervalued according to this. So, I just want to be clear. I'm not saying you should buy or shouldn't buy either one of these stocks. I'm just using it as a comparison to show, one stock's undervalued in a lot of metrics and one's overvalued. And one's growing, one's not growing. But I think both of them are expensive. I wouldn't buy either one right now. I think the market as a whole is overvalued. But if you had to buy one, you don't want to buy a stock that you're overpaying for and isn't growing. That's a sign of potential future problems. Now, if that stock, best case scenario is that stock goes nowhere. That's the best case because none of the numbers are growing. So why would the stock grow? But we live in an environment where everyone's indexing and they're one of the biggest stocks. So all the money goes into that stock and pushes up, which means it gets more and more expensive. It's a train wreck waiting to happen. And I have not heard a single person talk about this stock and their lack of growth. Not a single one. Which means that no one is paying attention. They're just sitting there sipping their coffee saying, oh yeah, we're just going to put all our money in that stock. Not going to look at the financials. Don't worry that they're not growing. They'll eventually grow. And I won't, if I talk more about how bad the company is being run right now, you'll know what it is. So I want everyone just to think about, what are you investing in? Are you overpaying in a market that is not being forgiving for expensive stocks? That's why when I say if the market drops 50%, it will be historically valued normally. That should scare the pants off you. We are very conservative in our portfolios right now because that scares the pants off me. If it drops 50%, that would be normal. Does that mean the market's going down 70? Probably not. I don't think it will. I think it'll probably go down 30 or 40%. But you should be prepared for bad scenarios. And if you're not, then you're setting yourself up for disaster. So anyone who's looking to invest in this market, be very cautious. Make sure you're investing at good values, at good prices, good ratios, things that you could be comfortable holding through bad cycle. If you're getting, I think one of the cigarette companies is paying like 8% dividend yields or something crazy. As long as that's a strong cash flow that's supporting that, who cares? You're getting 8% a year for holding onto a stock that's not going anywhere. I'm cool with that. 8% is a pretty good yield. So do your homework, do your research. Don't just blindly put your money into stocks. If you're an indexer, I'd be very cautious. But do your homework. Doug, final thoughts and wrap it up today?
Yeah, I think you make a good point. I want to say something about the last piece on the dividend. You made a good point when you said, there's a tobacco company out there, 8% dividend. But the underlying thing I want to make sure people hear is make sure it's got good cash flow, because there is a correlation between companies that will tend to increase dividends at a time in which their overall financial health degrades. Pitney Bowes is a perfect example. They were continuously increasing their dividend while the outlook of their business model was degrading into obscurity, because we don't use stamp machines anymore and all the things that they used to have a monopoly on. So make sure, again, I like dividends are great. I mean, if you can get 8% dividend, you're beating the market, as long as the value of the stock doesn't go down by 8% to 10% on a consistent basis. So make sure that if you are looking for dividends, that you look for dividends from healthy companies that really are in a position in which growth is not their focus. Their focus is sustaining. This is why utilities have, been, dividend darlings for a long time. They don't really do anything. They do terrible in up markets. But, the consistent dividend is there and it's predictable all the time because guess what? People are going to pay their electrical bill and they're going to pay their gas bill and they're going to need it. And it's going to be there no matter what happens. When everything hits the what, they're still going to need to heat their house and have lights on. So, they're going to be subject to, costs of fuel and stuff like that. And obviously, but look, we've seen it. Utility bills have gone through the roof. So guess what? They can still raise their prices. So I think that's an important detail to consider. And then, the other thing too, we talked about this last couple of weeks is, or probably last time we talked, is that people don't understand indexing. And yeah, the Mag 7, they look at the S&Ps, they look how diversified I am. No, you're really not. If you look at the returns of the S&P without the Mag 7, it tells you that basically you need to understand that the way the S&P works, being that it is a market cap driven index, is that you are basically at the whim of the highest market cap holdings in it, which is why the Mag 7, being such, have dominated those returns. And I'm going to get a little bit pseudo-political here. You've got people out there, politicians I won't name, going on air saying, I am so happy to see the Tesla stock is tanking. Wonderful. I looked at my phone and look how much it's going down. This politician is the head of the committee that runs the investments for the pension for that state, of which Tesla is one of their biggest holdings. Okay. Understand that this is not, this politicizing of, whether you like Musk, Trump or not, at the end, these are politicians making decisions that are undermining their pension holders because of the emotions of what's going on, of what they think or like. And so wishing for the demise of Tesla when you just showed, Kirk, that Mag 7 is 95% of the performance of the S&P, and it's one of the major holdings in almost all of the pensions out there, is absolutely working against the people that they say they're defending. I'll leave it at that. So speaking of working against the people they're defending, and let's talk about education. And let's talk about the fact that we now have, and we can talk a little bit more about this later, but the majority, it's an incredible number that just came out, and I'll use this as a transition, of people that are, of parents and families that are now financially supporting at least one of their adult children. Okay, it went from 45% of parents were supporting in 2023. It's now up to 50%. Now, some of this has to do with the decisions they've made, the careers that they're going after, but a lot of it also has to do with their education decisions and whether or not they've got a degree that ended up producing a viable income and sustainable income in the world that we're in. Okay. A lot of people go to college and guess what? They're shopping their degree when they're done. If they get out in 4, if they haven't cost their families by going to 6 years, listen, it's really important, and it is becoming a bigger and bigger impact. They say that in the next 2 years, they're going to potentially cut off a lot of these families, a lot of these people they're now giving their children an average of $1,400 a month to sustain them. Well, guess what? These parents are looking at their retirement and watching their retirement disappear. Many of them are carrying college debt. All of this adds up. You've got to make great decisions about college and make sure that it's an education, if you're going to go, that is going to support an opportunity to sustain yourself. This means taking the time to understand the trends, what you can make, how to go to school for the right reasons, how to get out in 4 years, and how to finance it the right way so that you're not fleecing your future retirement. They are tied together. You cannot make one decision without the other unless you're without facing collateral damage to everything else. And if that's important to you, if you want to be able to have the retirement you've dreamed, but you also want to watch your children set up to have the future that you both have dreamed as well, you need to have a plan. Hope is not a plan. We say this about everything. And if you want to learn how to protect yourself and give them the best opportunity, do your research. And in many cases, just like you do with your taxes, just like you do with legal situations, get professional help to do it right and do it right now. Go to our website, Mergent College Advisors. That's MERGENT, MERGENT, mergentcollegeadvisors.com. Go out there, start to get some information, because your future can't be made up if you spend it today.
Great. Well, thanks for joining us, Doug. And that's the show for this week. Thanks again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On their website, you'll have access to the show notes, resources, and the archive shows. Lastly, check out our YouTube channel. When you're there, please subscribe and leave a comment. And don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do.